Hey everyone, welcome back to Invest with Jiri. Today we are diving into a pretty interesting topic. Why John Bogle didn't like ETFs.
Using the proper ETFs and using the proper ETFs in the proper way is a perfectly intelligent strategy, just so long as you don't fall for their basic selling proposition, which is you can get out of the market in the middle of the day, any time you want to get out, real time, sell them in real time. There's this terrible investment strategy, but you don't need to do that. The temptation is there.
So for those who might not be familiar, John Bogle is the legendary founder of Vanguard, the guy who basically invented the first index fund. Even though he is known for revolutionizing investing with his groundbreaking ideas, he had some pretty strong feelings about ETFs, and we are going to explore why that is.
Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is.
His perspective is particularly insightful given his influence on modern investing strategies. So what exactly did Bogle think about ETFs? Well, he had some pretty strong opinions and concerns. We'll talk about those and also take a closer look at his overall investing philosophy and how it influenced the creation of Vanguard's S&P 500 Index ETF ticker VOO. Plus, we've got some insightful quotes from Bogle himself that will shed light on his perspective, so make sure to stick around. Understanding his thoughts can give us valuable lessons on investing wisely. Before we dive deeper, let's take a moment to appreciate the massive impact ETFs have had on investing. They've exploded in growth, with assets reaching trillions of dollars worldwide. This boom has transformed the investing landscape, making it more accessible and affordable for everyday people to invest in a diverse range of assets. However, with this great power comes some potential pitfalls that are worth nothing. It's crucial to be aware of both the benefits and the risks. Now, who was John Bogle? He was a towering figure in the investing world, famous for creating the first index fund back in 1975. This innovation was a game changer because it offered a low-cost, diversified way to match the market's performance rather than trying to beat it. Bogle championed simplicity and long-term investing, which stood in sharp contrast to the more complex and high-cost strategies that were popular at the time. His ideas helped democratize investing and made it accessible to a broader audience. Bogle also had some significant concerns about how ETFs were regulated. He observed that the ETF market was growing rapidly and this growth was outpacing the regulatory framework designed to protect investors. This regulatory lack could potentially create risks that people might not fully understand or be aware of. Bogle advocated for strict regulations to ensure that the ETF market remained safe and reliable for investors. This perspective highlights the importance of a robust oversight in financial markets. Bogle was a huge advocate of index funds, which now make up 28% of the market, with ETFs being a significant part of that. But he wasn't too happy about some of the ways ETFs were used, particularly the narrowly focused and actively managed ones. He famously said, "I couldn't care less if an investor decides to go into the Vanguard S&P 500 ETF or into the Vanguard traditional index funds. They both own exactly the same portfolio." This shows his preference for simplicity and cost-effectiveness in investing.
I couldn't care less if an investor decides to go into the Vanguard S&P 500 ETF or into the Vanguard, I had to create a word for this, an acronym to go with ETF, TIF, Traditional Index Funds. They both own exactly the same portfolio. They're both part of the same portfolio. Their returns will be identical. They both go for around 5 or 6 basis points at the Admiral class level. We had many years ago when I was running this place, and I perceived a little bit about the future, and we put on a pricing thing where you got higher returns as your average investment rose. And I think now the Admiral threshold is maybe $10,000. So if you're down below 10,000, you're probably paying 10 or 12 basis points. So once you get to 10,000, and they will be identical.
Index ETFs are designed to track a specific index, like the S&P 500 or Nasdaq 100. They hold a portfolio of stocks that mirror the index's composition. For example, the Vanguard S&P 500 ETF ticker BOO holds stocks of the 500 companies in the S&P 500. These ETFs are great for long-term investors because they are low cost and passive, meaning no active stock picking or frequent trading. They offer a straightforward way to invest without much fuss, which aligns with Bogle's philosophy. On the other hand, regular ETFs can be more diverse and might even be actively managed. They don't always track a specific index but can focus on sectors, themes or strategies. For example, there are ETFs for tech companies or emerging markets. While these can offer potentially higher returns, they often come with higher costs and more risk. It's important to weigh these factors when considering different ETFs, especially if you're aiming for long-term stability versus short-term gains. Bogle also talked a lot about financial advisors and their interaction with ETFs. He noticed that some advisors might push certain ETFs for higher commissions or incentives from fund providers, leading to biased advice. Bogle always encouraged investors to find advisors who work in their best interest, not just for their own benefit. Finding a trustworthy advisor can make a big difference in your investment journey, as they can help navigate the complexities of investing with integrity and transparency. One of Bogle's main issues with ETFs was their potential for misuse. He warned that the ability to trade them throughout the day might lead to impulsive decisions, especially during market volatility. He said when trouble comes, investors might believe they won't react to midday market swings. However, many end up doing so, reacting hastily to fluctuations that, in the grand scheme, hold little long-term significance. This frequent trading can be counterproductive and undermine the benefits of a long-term investment strategy, which is central to Bogle's approach. Bogle also wasn't a fan of niche ETFs, which he saw as more of a marketing gimmick. He thought these funds often capitalized on fleeting trends rather than offering real value. For instance, he criticized ideas like the emerging cancer ETF, which he thought were poorly conceived.
The idea of investing with the fruits and nuts, it's just, we had, when these funds started, somebody brought out, I don't think this is much of a name, by the way, a fund called Emerging Cancer ETF. And first of all, it should have been curing emergency cancer or something. It sounded like they were hoping everybody would get emerging cancer. And I criticized that particularly in an article I wrote about ETFs in the Wall Street Journal. And the guy who started it wrote me I thought a kind of plaintive letter. And he said, look, I deserve the same chance to try my ideas as you deserve when you started the first index fund. Well, is there a difference between selling quality and selling junk in your first idea? So I guess I gave him a nice answer. Go for it, man. Emerging cancer is long gone.
He believed that the more outrageous the ETF idea, the more it appealed to marketers looking to cash in on novelty rather than providing genuine investment merit. This highlights his skepticism towards funds that prioritize gimmicks over solid investment fundamentals. In summary, Bogle was skeptical about ETFs due to concerns over investor behavior and the rise of speculative niche products. He always promoted disciplined, low-cost investing through broad index funds and urged people to focus on long-term goals rather than getting distracted by short-term market fluctuations.
The choice of ETFs is the large, broad market ones, and the way to use them for the individual investor in all cases is not to trade them. So buy and hold, buy and hold, buy and hold.
His approach emphasized a steady, principled investment strategy that sought to avoid the pitfalls of market hype and speculation. Thanks for tuning in. If you found this video interesting, don't forget to subscribe to Invest with Jiri for more in-depth explorations of investing strategies and financial insights. Stay informed and invest wisely.